this video, I'm going to look at what a tax-efficient investment looks like in the Australian tax system and how you can compare your investment choices with tax in mind. I won't be covering common tax strategies like negative gearing or investing in the lowest income spouse's name, or using different tax structures like superannuation funds or family trusts. Instead, I'm going to focus on just one consistent tax rate of 34.5%, including Medicare levy. So is it more tax efficient to receive fully franked dividends? Let's look at an example of two popular Australian investments. AFI versus VAS. I will be getting my data using the share checker function on ShareSite that you can find here in the home screen. Now, if I invested $10,000 on the 1st of July 2022 in AFI, the ShareSite report says I would have bought 1,315 shares at $70.07 each for a total outlay of $9,994. Now, if I add this investment to ShareSite like this, I can figure out how much income and franking credits I would have earned for this one investment for 1 year. ShareSite tells me for the 2023 tax year, AFI would have paid out $328.75 in dividends that were 100% franked. So a quick recap, franking credits are taxes paid by the company on the income it earned. Since AFI is a company that receives incomes from its investments in other companies in its own name, it is required to pay company tax at the flat rate of 30% for large companies. The franking credits paid by AFI are then passed on to its investors of AFI when it pays a dividend. The whole purpose of franking credits is to avoid double taxation on earnings that the company pays and then what the shareholder receives from dividends. This is very tax efficient and is unique in the investment world. Next, if I invest another $10,000 in VAS, an index tracking trust run by Vanguard, on 1 July 2022, using the ShareSite, I would have purchased 123 shares at $81.17 per share for a total cost of $9,983. As VAS is an ETF, or an exchange-traded trust, it doesn't pay company dividends per se, as it is not a company like AFI is. Instead, in 2023, VAS paid out a trust distribution to me of $341.61. Since it is a trust. Trust distributions are not dividends, which is a common misunderstanding. A trust distribution looks a lot like a dividend from AFI and is paid directly in cash to my bank account as a lump sum each payment cycle. The only difference of a dividend and a distribution appears at tax time when you are filing your income tax return. This is because a trust distribution is made up of different components for tax, such as franked Australian income, unfranked Australian income, capital gains, foreign income, foreign tax credits, deferred income, and so forth. This means that you need to show this income in different sections of your tax return. I have created a video on how to complete your tax return when you have received a trust distribution step by step. I will include a link to it in the description of this video. In comparison, dividend income is shown in just one section of the tax return with franking credits shown near it, like this. Most Australian dividends are pre-filled in your Australian tax return by the ATO by mid-July usually, whereas ETFs are not usually included in your tax return pre-fill until at least mid-August, since there are many differences between what is paid in cash to you and what you need to include in your tax return. In terms of tax compliance and the time to prepare your tax return, receiving a dividend is much easier, and you usually don't need to wait for the pre-fill to complete your tax return. Now, if we compare the dividend paid by AFI with the trust distribution from VAS, before we do that, if you're finding this video helpful, please do me a favor in pressing the like button and consider subscribing for more videos like this. It really helps me to make more videos and supports my channel. Thank you. Now, if we compare the dividend paid by AFI with the trust distribution from VAS, an interesting picture emerges. Using ShareSite's tax reporting features, I can see that the dividends paid by AFI is less than VAS. However, AFI provides a 30% franking credit of $141, making my total taxable income $469 for AFI. Taxable income is the sum of the dividend of $328 paid in cash plus the $141 of franking credits. If the taxable income of $469 is assessed at a tax rate of 34.5%, then gross tax is $153 before franking credits. However, we can reduce this tax by using the $141 of franking credits received. This means the total tax payable on this income is only an extra $12. Now, VAS paid a slightly higher trust distribution in cash of $342. It also distributed franking credits of $129 since it invested a lot in Australian shares, just like AFI has. However, the trust distribution is not fully franked at a rate of 28% compared to 30% like the AFI dividend. Now, in your tax return, your taxable income for the VAS distribution would be $465 after adding the franking credits and then subtracting the $7 of the non-assessable component of the trust distribution called a tax-deferred amount. A tax-deferred amount actually reduces the cost base of the investment, which will result in a tax event when you sell the investment later down the track. Also with VAS, there are no capital gains distributed in the 2023 VAS payment. So this avoided more complex CGT calculations, which I've covered in another video, which I'll include in the link. So the gross tax payable at the 34.5% marginal tax rate is $151. However, this time we are subtracting less franking credits of $129. Also, there was some foreign tax credits distributed of $1, which also lowers the tax bill. All up, we must pay $21 of tax. So this year, it appears at first glance that VAS was less tax efficient since my tax bill is higher. However, another way of comparing the tax efficiency of investments is comparing the after-tax return on investment as a percentage. In my example, even though AFI distributed more franking credits, it has a slightly lower return on investment after tax at 3.16% versus 3.21% for VAS. This is simply because VAS had paid a higher distribution in cash of an extra $14. Why did VAS distribute an extra $14 when it mostly invested in the same Australian shares as AFI? Well, there are many variables and there is no simple answer. One simple explanation is that VAS passes all the income onto its unit holders 4 times a year, as it has no other option. In contrast, AFI pays out the maximum dividend that it is fully franked as a company policy. If AFI has received more income than it has paid tax on, at the 30% rate, it will retain that income and likely will pay it out in the following dividend period when the company has built up more franking credits to pass it on. So essentially, it could be just a timing difference. You may find one of these videos on your screen helpful to watch next. Thanks for watching. See you next time.